Well, GNFC is in focus today and the stock itself has risen by 18% over the last two trading sessions. Over the last year itself, 142% return, and the volumes of the last two trading sessions coming in at almost 4 to 5 times its 20-day average. Well, the strong set of numbers were, of course, the most important part which has aided the rally, especially for both the chemical segment and the fertilizer segment in which the company operates. For chemical segment itself, almost the revenue grew by almost 64%, while the fertilizer segment itself saw an uptick of 46% on a year-on-year basis. Now we delve into deeper. The margins have actually improved overall, if you see, and they have remained protected, especially because of a high realizations coming in from outputs. And while for fertilizers, a strong subsidy from the government aided the numbers. Now the quarterly numbers, as we see, the revenue show a strong jump of almost 58% and an EBITDA jump of almost 86%. And surprisingly, the margins that have also jumped by more than 400 basis points. Now, if you see the triggers going ahead, the company itself is a debt-free company, and the company also relies on the China Plus One strategy, which will actually help the exports going ahead. Apart from this, the valuations do remain attractive as compared to peers. And lastly, the capacity enhancements projects are supposed to be undertaken for the various chemical segments. Now, we did speak about the positives, but there are a couple of key risks which the management has pointed out in the statement in Q3 earnings. They did point out that the input costs have impacted the fertilizer imports, and apart from this, the feedstock for chemicals such as natural gas and oil, they have also risen, and that input pressures would be actually transferred over the coming quarters. And apart from this, the logistic disruption due to COVID-19 does remain a cause of concern.